What if I told you the world's most successful investor just bet against the stock market? Not with words, with $341 billion in cash. Warren Buffett isn't buying the hype. He's not buying stocks. He's not even buying his own company. Why? Because he's seen this before. In 1999. In 2008. And every time he makes this kind of move, the market crashes. And here's the wild part. He's the only top billionaire actually making money in 2025. So what does Buffett know that you don't? Let's break it down. And more importantly, let's figure out what you should do about it. You probably didn't hear Buffett say anything recently. No interview, no shareholder letter, no press tour, but make no mistake, he is speaking through his money. Buffett just sold off over $130 billion worth of stocks, and now he's holding over $341 billion in cash. Let me say that again. 1/3 of Berkshire Hathaway's entire value is just sitting in cash. No tech stocks, no growth plays, no doubling down on anything. He's parked it in short-term U.S. Treasuries, earning 4 to 5%. That's $13 billion a year in interest for doing nothing. Why? Let's rewind to 1999. Dot-com mania. Stocks were booming. Everyone thought Buffett was out of touch. Sound familiar? That year he wrote to shareholders, warning that the market had become disconnected from reality. He said investors were overconfident, overpaying, and expecting too much. People laughed at him, called him a dinosaur. But then came the crash. From 2000 to 2012, the S&P 500 returned just 2% per year. After inflation, that's basically zero, a lost decade. Buffett avoided the mess. And now, in 2025, he's doing the exact same thing. Let's look at the data behind his decision. One of Buffett's favorite metrics is now known as the Buffett Indicator. It's simple. Take the total market cap of U.S. stocks and divide it by GDP. It shows you whether the market's rise is backed by actual economic growth. In 2000, the ratio hit 140%. The market crashed. In 2007, it surged again. Another crash. In 2021, it hit new highs, followed by, another correction. Right now, the Buffett Indicator is sitting at 177%. That's not just high, that's dangerous. And Buffett called this the single best indicator of overall market valuation. So yeah, he's watching it, and if he's watching it, so should you. But that's not the only red flag. There's another one. The CAPE ratio. It compares stock prices to average company earnings over the past 10 years. It smooths out the short-term noise and shows you the big picture. It spiked before the Great Depression in 1929. It was sky-high before the dot-com bust. It was elevated in 2008. And now? It's at 33. More than double the historical average, so even if the headlines say investors are scared, the valuations don't lie. We are still way above normal, and that's when bad things usually happen. Buffett has this brilliant metaphor about what happens during market euphoria. He compares it to Cinderella at the ball. She knows she needs to leave before midnight. She knows the magic wears off, but she's having too much fun. Sound familiar? Buffett said most investors are like Cinderella. They know it's risky, but they just want one more dance, one more gain, one more rally. And here's the punchline. He said, they're dancing in a room where the clocks have no hands. They don't know when midnight is, they just know it's coming. Buffett, he's not even in the room. While everyone else is guessing the next AI winner, Buffett is quietly collecting $13 billion a year in interest. No stress, no chasing, just compounding. You don't get to be worth $130 billion by following the crowd. You do it by staying disciplined, staying patient, and preparing to strike when others panic, just like he did in 2008. Back then, while the market was falling apart, Buffett invested $20 billion into companies like Goldman Sachs when they were down bad. That single move made him billions, not because he predicted the crash, but because he had the cash, the patience, and the guts to act when it mattered. He even said it himself. We've not been good at timing. We've been good at getting value for our money. That's the key. Charlie Munger, Buffett's longtime partner, summed it up even better. He said, the big money is not made in the buying or the selling. It's made in the waiting. And he added, wise people bet big when the odds are in their favor. The rest of the time, they don't. That's Buffett's strategy. It always has been. So what can you take from this? You're not Warren Buffett. You don't have 300 billion in dry powder, but you do have something even more powerful: time, discipline, and a plan. So let's build one. Step 1. Start building your dry powder. That means saving cash, cutting the junk, parking your money in safe interest-earning places. High-yield savings, short-term T-bills, whatever works. Even $200 a month adds up fast. Step 2. Protect your mindset. Don't follow hype. Don't YOLO your cash into the next meme stock. And definitely don't take advice from anonymous traders on social media. Stay calm, stay focused, stay boring if you have to. Step 3. Be ready to strike. Crashes always come, always. It's not a matter of if, it's when. When they do, you want to be one of the few with cash, courage, and a watch list. Buffett isn't afraid. He's not in hiding. He's waiting. So wait with him. You don't have to predict the crash. You just have to be ready when it comes. Because when it does, two types of people show up: the ones who panic and sell everything, and the ones who buy the dip and change their lives forever. Which one are you going to be? If this helped you see the market more clearly, hit that subscribe button and let's stay smart together. Now tell me in the comments, are you building dry powder or still dancing at the party? Because trust me, midnight is coming.